I'm Darren Coleman, Senior Vice President and Portfolio Manager with Raymond James in Toronto. Welcome to another edition of Money in the Real World, and we're talking about real money and real people. And today I'm delighted to be sitting with my friend Rahim from Theta Strategies, who's the manager of the NextEdge Theta Yield Fund. Thank you for joining us today, Eden. We've had a couple of giggles as we've gotten settled and organized. And we're going to talk today about a fund that you're running that I find very, very interesting. And before we begin talking about the fund, though, I think it's important that we just kind of put a disclaimer out there that you and I know each other for 10 years-ish?
10 years, that's right.
Approximately? You put up with me that long?
West End Boys.
West End Boys, that's right. It's not a gang. There's a bunch of hedge fund managers and me that all got together a long time ago. Before we get to the fund and what you do, which is very, very unique in Canada and very, very helpful for us, your background is very interesting. So just give us, a couple of minutes or seconds on kind of how you became the manager of this fund and kind of what your experience and success has been like in the past.
Sure. First of all, I'd be remiss if I didn't mention the fact that one of the unique things that I've discovered about you and I've seen over the past years
I have no idea what you're going to say now.
You go to great lengths to find interesting portfolio managers that we've talked about over the years.
Yeah.
And even a format like this, you've been very progressive in finding ways to engage with your clients.
This is so Mom can watch it and find out what I do all day. So thank you.
So no, I find that very interesting. But my background is I have a science background in molecular genetics, but my career is really in finance, and I joined RBC back in early '94 as a derivative analyst, and based on some successes there and a variety of hedges and income trades that I'd done, became a portfolio manager, and we reversed a 10-year fourth quartile growth fund into a 5-year 5-star.
Right, yeah, it was pretty legendary to turn that fund around at RBC.
And along the way we've had some great trades, and we've traded through the crises and so on. But back in early '94, I was given a mandate for managing biotech at RBC.
Right.
So I was able to generate a 9-year track record of 26% compound rate of return.
Fantastic.
And so it's an eclectic range of derivatives hedging, option strategies, structured notes, growth portfolio manager, and biotech.
Yeah, we were talking about this earlier. So you're one of Canada's foremost options strategists, biotech investors. You also play the guitar, the banjo, and the trumpet. And if you paint watercolors and drink pina coladas, we're going to be getting married. So, but that background, you're also, I should note, a real student of market history and finance history. And you've got one of the most incredible collections of newspaper clippings and other things from the Great Depression and the market crash of '29. Like, you're a real student of that, aren't you?
Well, that's actually a fantastic memory that you actually remember that stuff. I think you might have even seen it.
I did. I remember seeing some of the clippings and things. Don't touch that. No, but you're very good about that.
But it actually goes back to 1720 at the actual top of the South Sea bubble.
Right.
The bubble that subsequently led to a 60-year bear market in the UK. Mm-hmm. And it's a bubble that actually caused Sir Isaac Newton to say that the orbiting of celestial bodies I can understand, but the irrationality of man I cannot understand.
Because he's been right ever since.
He's been right ever since. And so for virtually every great market cycle, peak and trough, since that point, I have magazines, newspapers, and so on that sort of documents each of those cycles, which is, it's boring to most people. It's interesting to me. In fact, a professor at Columbia University once came to my office and asked me to donate that collection.
Is that right?
To Columbia University.
Wow.
Yeah.
And did you?
No, I didn't.
No, because it's going to make one hell of an episode of Antiques Roadshow for your kids one day. It's going to be great. Anyway,
my son actually said he'd sell it on eBay.
Oh, well, I'll be the only bidder maybe. So, okay, that's fun. Let's move on to the fund and what you're doing now, which we find so interesting. So, just to set it up, one of the things that we found very, very difficult, one of the reasons why we've had to be a bit more innovative, is that we're in this period of time which is historic. We're in a low interest rate environment that we all know about. We've been in it for years. But we haven't had anyone who's actively managing money who's still alive that was doing it back in the 40s and 50s the last time we were in this kind of interest rate environment. So we are really trying to find better ways for us to find high quality, low risk strategies that generate a strong income in portfolios for clients. And, we have our stock exposures, we have the businesses we like to invest in, but what else can we do to help diversify portfolios? Because we know that the traditional way we would do that by using bonds is going to be very problematic going forward.
Yeah,
so it's led us to try and find other things. So the strategy that you're running in the Theta product is, I guess, built on your experience as an options manager, an options trader, and you're running a strategy that's called the Iron Condor. So this may win a Trivial Pursuit game for someone, which is a strategy that takes advantage of a fairly natural phenomenon in options markets, right?
That's
now,
right.
by the way, we're going to superimpose some slides on this through the magic of television to help explain some of this. But could you just give us the challenge is you're a genius, and I should put my glasses on to get a few IQ points. You're going to have to explain this in a way that we're all comfortable with, so please do.
Sure. Well, first of all, just a historic background. Bonds basically trade in a 60-year cycle.
Okay.
So it's either 20 to 30 years up, 20 to 30 years down. And going back about 220 years, we are in probably the greatest bond bull market in history.
Right. We're at the end of it, aren't we?
I think perhaps so. We're at least near the end of it. Whether or not interest rates actually rise sharply or just meander sideways for a period of years is open to discussion. But I think, usually bull markets begin in a cauldron of chaos.
Yes.
And if you go back to 1981, you remember that Paul Volcker had just cut credit to the markets, interest rates soared. And it's about the time that some of you might remember that Ronald Reagan cut the air traffic controllers, the PATCO workers.
Yeah, that year, grade 7, was a rough one.
So it was an amazing year, 1981, but that's when interest rates, the U.S. 10-year Treasury, topped at around 17%,
Okay.
which is unthinkable to anyone in this
today,
era.
that's right.
Exactly. But then it began this 33-year advance. Now, we know, I think intuitively, most of us understand that with interest rates being where it is, it's probably not sustainable. We've seen interest rates go negative below 10 years in Europe. We've seen interest rates below 2% at the 10-year level. At best, maybe it stays here. I'm not saying that we have this draconian backup in rates, but it probably, for most of the history of the Western civilization, it's been a few percent higher than this.
Right.
So that being said, the entire world, we've had 33 years of money flowing and benefiting from rising bond prices.
Okay.
We've been here before. We remember back in late 89, early 1990, that Japan couldn't sustain where it was. We
That's
knew
right.
back in late 99, 2000, that the NASDAQ couldn't sustain where it was. We knew
Right.
back in 2007 that housing couldn't sustain itself where it was. And we have the same intuitive sense that interest rates probably can't sustain itself where it is, given the amount of liquidity that's
That's
been
right.
put in the
So
system.
the next move, obviously, to everybody has to be up at some stage.
Yeah,
Has to
exactly.
be.
And we've seen it that even since 2009, we've had 3 or 4 episodes where, during QE periods, where we've seen long bonds back up 100 plus basis points really, really quickly.
Mm-hmm.
And what happens is that you see your underlying holding in a bond drop 10% very quickly. And it takes years at a 2% interest rate to actually make that back.
That's right.
And we're probably in the midst of a period for many years where we see something like that happen,
Okay.
where bonds chop for a bit. So, just recently, just in February, we've seen 10-year yields back up, 40, 50 basis points?
Mm-hmm.
Just an amazing move.
Right.
That's a 30% back up in yields in a short period of time.
Right.
And we're probably in for a lot more of this. So about, I guess sometime last summer, I was at a conference, and there was a panel of allocators from pension funds.
Mm-hmm.
And when they ended the panel, 3 out of 4 of them said one critical thing: we have a pressing need for innovative ways of delivering yields, because
Right.
they have a major problem.
Yeah, and ours is no different.
Exactly.
That's right. Ours is no different.
And we saw Japanese pension funds a decade ago have a similar problem.
Very true.
Right?
Yeah.
And yields got so low, they just couldn't earn a return to meet their obligations. And we think pension funds probably have a similar problem. So we think that finding innovative ways to deliver yields, bringing different skill sets
Right.
to a problem and providing solutions is one way of doing it. And we think that we have something with what we've created here.
Right, so we're going to, as I say, show some charts. One of them was kind of what bonds have done, so we'll show that big chart of interest rates going up and then down, and that's
Yes.
defining kind of the environment we're in. But then the other one we'll show is briefly how options work and what
Sure.
I think called time decay
Yes.
means, and this is important.
So one of the fundamental attributes of options is this. Shorter dated options expire at a faster rate than longer dated options. So for instance, the S&P right now is around 2050. A 1 month option on the S&P is worth about $34. An at the money option struck at 2050 is worth about $34. It decays at 60 cents a day.
Okay?
A 2 month option on this at the same strike at 2050 is worth $50. So it's worth, close to 50% more, but it decays at 40 cents a day.
Okay,
So if you sell a 1 month option
right,
that decays at 60 cents a day
Right.
and buy exactly the same strike option
Right.
with 2 months of life, it decays at 40 cents a day, you have a net gain of 20 cents a day.
Now, so what we're saying is that a longer term option, it gets worth, because as they get closer to expiry, they're worth zero.
Yes.
But it's not a straight line.
Exactly.
And so what you're capturing here is an idea that says, look, as they're older, they decay slowly, but as they get closer to when they're terminated, they accelerate down.
Exactly
And you're
right.
trying to capture that difference of decay, that rate at which they become worthless.
Precisely.
And so the interesting thing to me about this, as you described it to me, is that because you can use the same underlying security effectively, we don't have any market risk.
Right.
We take that out, right?
Yep.
We don't really have interest rate risk. We don't have stock market risk. We take away a lot of the risks that we may be having in other places in a portfolio.
Exactly. You're not taking directional risk.
Right, market up, market down, doesn't matter,
You're
does it?
non-directional. You're not playing. You're just exploiting a mathematical property. Now what's unique about this is that, while this is novel to retail, for institutions,
Yes.
it's de rigueur. It's basically a standard way of earning extra returns. So pension funds, sophisticated pension funds, sophisticated Wall Street brokerage firms, and so on, they will manage your option books using strategies. We use about 3 or 4 proven strategies, low-risk strategies that
Okay.
we do to earn our returns. And so while it's novel, for retail, it is not at the institutional level.
So that's interesting. So this is a strategy that's been time-tested, clinically proven. The big money uses it.
Yes.
How come it's never really been available or utilized by average investors, by wealthy individual investors, by common individual investors? How come we've never seen it before?
Because it takes a fair amount of work.
Okay.
It takes a fair amount of analytics. It
Right.
takes experience. My partner Michael Bird and myself, we have 50 years options experience in Canada. It's at several points in my career, I've been among the largest option traders in the country.
Right.
And so, it takes a fair amount of experience to manage strategies like this. It's multi-legs. It requires several option positions. But at no point is there any kind of open-ended risk or anything like that. So I think that, while you have institutions that do these strategies, investors in a third degree of separation way have been exposed to these strategies. So you take let's say a typical bank structured note.
Yes.
You would buy a structured note, and they're very popular among bank investors, for instance. They would buy it from the bank. They would promise 25% maximum risk, and they would earn, let's say, a 6% yield, and if the index rallies 15%, they're capped out.
Yeah, like
Right?
we see these things in the posters at the various banks. They'll call them market-linked GICs or
Exactly.
equity-plus GICs and other things, which lets someone have some participation in the stock market
Yeah.
and with some degree of return.
Yeah.
But they don't get all of the return, but they also don't get all the downside. So
Right.
it's designed to be comfortable.
Right. Now, if you decompose that,
Yes.
what is it actually composed of? It's composed of holding cash and bills. You've got a swap on the index return. You buy a put option at a certain level down, and you sell a call option at a certain point up.
Right.
And you earn a net return.
Right.
So they are used to buying securities with multi-leg options in it.
I
They
see.
just never describe
No
it
one ever
as
told
that.
them that.
No one ever told them that.
Gotcha.
They just buy one security, and this is what the risk-reward profile is. What we have done is this.
Now, by the way, when the bank builds this, do they make money off of them?
a substantial,
We can laugh at it. Of course the banks make money. Of course they do.
there is a substantial fee
Yes.
built into it.
Yes.
The options that are priced are not exactly the most favorable priced options.
Right.
And it's binary in the sense that it's either or. So you don't earn, even if there's time value left on the options, that doesn't accrue to the investor.
Right, that accrues back to the organization.
Exactly right.
Okay.
So what we do is we have made the advantages of those multi-leg strategies accessible to investors through a mutual fund, a fully registered 81102 mutual fund.
Yeah, so this is easy for us
daily
to
liquidity.
access. We don't have to be accredited investors. We don't have all
Exactly.
these challenges with transparency and liquidity and everything else. It's easy to buy.
And you're not locked up for years.
Right.
You have daily liquidity. The index options are all exchange listed, either priced daily, tremendous liquidity, and you have much less risk. We're not giving you 25% downside risk.
That's right.
We're earning the return. You can see it happen, and you're not capped out either. So the goal is really non-directional. Earn these premiums each month, and just compound the return, pay a distribution out, and then earn a compound return. Now, the other...
Sorry, just before we go on. So our expectation of return, are these strategies designed to try and make 5% a year, 25% a year? Where do you kind of see the kind of natural return fitting in this, given the low risk attached to it?
So we hold mostly bills. We write a small amount of premium, roughly around 3% of the net asset value in premiums each month. The goal is once a third of that premium has been eroded due to time value, passing of time. Again, the one certain thing is death, taxes, and the erosion of option premium with time.
Right.
And so once about a third of that premium has eroded, we close the position out and we're done.
Okay.
Right? And that's the aim. We're not trying to hit home runs. We're not trying to knock the ball out of the park. We're not trying to make headlines with anything. We're really just trying to be slow and steady, earn the option premium, bring a different skill set to the available choices to investors.
Right.
Now, again, the other thing about options that investors actually invest in that they're not even aware of is you take popular securities. You take something like a mortgage-backed security or
Yes.
a callable bond.
Yeah.
If you decompose that, that's essentially a bond with a short call against it.
That's right.
Right? A prepayment call
Yep.
option. It enhances the yield, but they never see it as that. Or you take a convertible bond. A convertible bond is a straight bond with a call spread.
That's right.
But they never see it as that.
No.
Right? But that's what it is. And so what we've done is we've basically taken these same strategies, except we've focused on that one
Just
short
that one
principle.
element. Just that one element.
One single element,
Okay.
which is options lose their value with time. And I think we've all experienced that. And for many of your clients that have done covered calls and stuff like that or put rights, they understand that.
Actually, on the covered call thing, before we move on, I should note that many of our clients have used a covered call ETF to try and drive more yield into the portfolios and let volatility in the market actually pay us more money.
That's correct.
And I have to just stop and say, you're the guy who built them.
Yes.
And that's why we started using them. So thank you for that. It's worked out really well for us. So from our perspective, we can kind of look at this strategy and say, look, it diversifies the rest of the portfolio, gives us a different way to make money, which is critical in terms of reducing risk, right? Because reducing risk is not about taking less risk. It's a bit of a paradox.
Right.
To get less risk, you have to actually take more, provided they're different.
Yes.
Right. This is lots of eggs in different baskets and things, right? But we want to see kind of a return, or we should expect to see a return of about 0.5% to 1% a month is kind of
Precisely.
which is really what we were always looking to bonds to provide, right?
Precisely.
But we can't get them for bonds anymore. So
And again, because we're, with bonds, what people are going to realize, they haven't learned this yet, but they will realize at some point that when interest rates go from 2% to 3%, bonds will lose 10% of their value or more.
this fast,
Right?
Yeah, it's not a 1% loss. It's
Exactly
considerably more
right.
than that.
It's a substantial amount on a principal amount, and they're not there yet, but they've gotten a bit of that during February. We've seen bonds drop 7-8 points.
Right.
Right. So,
Right.
but they're willing to look through it at this point. But that's the kind of risk. We're not taking directional risk. We're basically holding cash and we're harvesting option premium.
Yeah, and when you say directional risk, that means we're not betting on the market going up,
No.
down, sideways.
No.
Greece, Spain, none of that stuff
We're
matters here, does it?
the one thing we know is every month the market will move.
Right.
We don't know which way it's going to move. Experts will say they know which way it's going to move, but we know
Right.
otherwise.
Right.
We're not there to forecast. We're there to say the market will move up or down, slowly or fast. Either
Right.
way, we will adjust, and whatever the market delivers, we will adjust our positions accordingly. We're there to harvest premium in a market-neutral way.
Now, is there anything that could go wrong in the implementation of this? Are there any risks investors should be aware of
Yeah.
in a strategy like this? Because there's always something that could be a fly in the ointment. So what might this
Absolutely.
be?
So the biggest risk and we actually went through that risk in February.
Okay.
Right? But we came out ahead. And so we were tested by fire the first couple of months that we've been going on this. So in February, the S&P rallied about 115 points in a straight line.
Yes.
From the get-go, day one, it just went straight up 115 points. When we set up credit spreads, we write roughly with a 10% probability the market will get to a boundary. But our management process means that as the market moves, we adjust our positions and we reduce our risk, and that's exactly what we did. So we went through a month where we should have been down, but we were actually up modestly.
Wow.
And that it was tested. So any extreme move in the market,
yes.
But that comes with a caveat. When the market's moving and it declines with speed and volatility goes up, we know that typically is what happens. We actually overlay tail hedges in our positions.
Okay.
Because we know the market will do the
and tail
unexpected.
hedges are taking care of those outlying risks of something
Exactly
happening,
right.
the unexpected.
Precisely
Okay.
right. We assume that's going to happen.
Right.
Every single month. We actually, the same way, for instance, with insurance. You pay a premium to the insurance company. They're put writers.
Yes.
And you will purchase insurance from them, and you will pay a premium, whether for your house, your life, or your auto.
Right.
And it's the same thing. We dedicate a certain amount of our premium that we collect to buying that insurance,
there's a
and we
big
fully
car
expect to
accident,
lose.
right.
Exactly right.
Right.
And that's we put that in there to match it up so that if we have an extreme, unexpected market move, it's offset by these hedges.
Right. So you also touched on one other thing, which is the fact that this fund is very new. So
Yes.
we're only a month or so into it being available, so we're
Yes.
very new on this idea,
Yeah.
which is great. So I'm going to wrap it up there.
Okay.
And as I say, we'll post some of the charts and things on the computer, and we're happy to talk to clients about it. It is it's interesting because it's very complicated in terms of how it works, but it's actually very easy for us to use, which is
Right.
a very nice, elegant solution for us.
Exactly.
I think we're going to have you back when we want to talk about biotech.
Sure.
Because I don't understand any of that stuff. And every time my doctor makes me get a needle, I have a lollipop. So I'm out of lollipops, so we'll do that when you come back. But I wanted to thank you for your time today. It's always been great to work with you, and I'm really appreciative of you finding something that continues to be unique and innovative and try to solve the problems that we're trying to solve on behalf of clients. So thank you very much.
Darren, I am sincerely appreciative of this opportunity, and I delight to talk with you again.
Good. Well, thank you. And thank you very much for watching. Again, I'm Darren Coleman at Raymond James. Please take the time to give us a call if you have any questions. And with that, thank you very much for watching.